My name is Mike Stanton. I'm Build America Mutual's head of strategy and communications. And today this session is going to tackle the municipal bond market in light of the volatility we've seen in the first half of this year. Joining me today are Nuveen portfolio manager Patrick Maher and deputy director of the New York City Mayor's Office of Management and Budget, David Womack. Before we start, I'd like to remind everyone that we want to hear from you. Please use the text chat to the right of your screen to post questions and engage in the discussion. We'll incorporate as many of those questions into the conversation today. And also a reminder that there is a poll question also on that right-hand panel. Please answer the question in the poll tab if you haven't done so already, and we will bring that into our conversation as well. So let's get into it. Patrick, as we said, it has been a really volatile first half of the market, particularly surprising for some investors who view the muni market as sometimes the most boring part of their portfolio. Can you walk us through what rising interest rates did to muni bond returns so far and what people are seeing as they look at their statements?
Sure. Well, so far we've seen about 190 basis point or so rise across the municipal AAA yield curve throughout the year. This has, depending on the duration and maturity of the bonds that you're invested in, led to a negative return of anywhere from 3 to 15% on the year. This is obviously something that's been quite more negative than most clients are used to seeing on a year in and year out basis, especially given the direction of rates over the past several decades. We found that over the course of the year, in addition to the rate moves, and not surprising as we've seen this in past periods, but the volatility in markets often creates an outflow cycle within the municipal space, and additional selling pressure that's moved municipal rates in kind of an even more negative direction. It's, as I say, been a very impactful aspect of client portfolios thus far year to date. But one of the kind of silver linings, if you can go there, has been the stand up in credit quality. And we've really seen that as a reflection of the different investment grade buckets. AAA, AA, single A have all had similar returns on the year, indicating that this is not necessarily a credit induced sell-off, much more of a rate sensitivity, similar to what we're seeing in broad high quality fixed income across the market space.
Thanks. And so as talking about high credit quality issuers, that's a great segue into David. New York City, year in, year out, is one of the largest borrowers in the marketplace. And you were selling bonds in a fairly large transaction during the month of May when we saw kind of a peak, or at least a short-term peak in interest rates, and they fell fairly significantly. Can you take us through kind of a mini case study of how that transaction went? What kinds of questions were you getting from investors? And were there any new faces? Were there different kinds of buyers as you went to the market?
Thanks for the question, Michael. It was a very interesting as you know. New York is one of the largest issuers in the municipal market, and we come periodically throughout the year. We don't have a lot of flexibility. We can move transactions around, delay if we need to, but we do need to be in the market. We do need to borrow. So as we approached our May transaction, we saw interest rates rising quite dramatically, and that was something we had to navigate in structuring the transactions. And we did see a somewhat different mix of buyers. We typically have a mix of bond funds, bank portfolios, insurance companies, SMA investors, and trading accounts. In this particular transaction, the trading accounts sort of took the lead. As Patrick noted, there was significant selling pressure from the bond funds that put a lot of pressure on the market and our transaction. There was also very strong interest on the retail end. Direct retail SMA investors, particularly, were active in the front end, 10 years and in. So seeing that but the selling pressure from the bond funds made spreads widen, and we had to really not scramble, but it took a little bit to put that transaction together, and we expect that volatility to continue.
So Patrick, you are closest to the SMA business, separately managed account business, and probably closer to some of the retail investors. Let's take a step back and just what are they looking for from their municipal bond investments, particularly in this market, and have have they changed their priorities at all as a result of the market volatility?
Yeah, I think through anecdotally, through kind of conversations, not just this year, but really over prior periods as well, we continue to find that most investors, especially in the SMA space, continue to be highly focused, obviously, on the tax-exempt or tax-advantaged nature of munis, not just at the federal level, but obviously state and local where applicable as well, but also high quality. People somewhat forget that municipals tend to be very high quality at an aggregate level, with about 70+% of the market being what we would consider to be high investment grade quality. Consider that to maybe the corporate market, which might be more like 50+% in the triple B range. And you get that, as you pointed out earlier in the call, a very core, somewhat stable, except in volatile interest rate environments, the portion of your portfolio that you can rely on for that tax advantage income.
And as credit quality moves forward, so one of the things that has boosted credit quality so far this year is this, somewhat unprecedented federal spending through the CARES Act and the ARPA bill that provided direct cash financing to states and local governments. How are people, I think the last ARPA checks are moving out right now. So how are people looking forward to the next 12 or 18 months is as far as credit quality goes? What's the expectation going forward?
Yeah, it's certainly in part because of federal stimulus over the course of the past couple of years, even though those programs are in the process of winding down, with funds needing to be spent in the not too distant future. But really, I think that the one larger buoy for most municipalities, especially in the higher quality space, has been an increase in just kind of your standard or normal revenues. If you think about where most municipalities collect the majority of their revenue stream from, property taxes at the local level, income and sales tax more at the state level, all of those have been at considerable highs for running periods now. I think the resilience that we expected to see from the market in terms of credit quality dating back 2 years not only came through, but really grew as those revenue buckets grew as well. At the same time, municipalities have done a very good job of keeping in check their expenditures. We note that through all of the upgrades we've seen, very few upgrades have been pointing towards the receival of federal stimulus as the reason why they're being upgraded. It's much more about managing their expenses, managing their debt load, putting away money into rainy day and stabilization funds that will allow those municipalities to weather the next storm when that comes. But to follow on your question, we see credit quality, especially at the state and local level, continue to improve or at least be stable for most credits over the course of the next year and a half, 2 years.
That's a great point.
I would actually echo Patrick's comments, at least in our direct case. As you're aware, Fitch upgraded our outlook from stable to positive for our last sale. And we certainly benefited from strong tax receipts through following the federal money, certainly bridged the gap through the pandemic, but the tax revenues remain strong and stronger than we expected. And we hope that expect that credit quality to continue, and we'll continue to manage our our expenses and our fund streams as we go forward.
I'll just throw in BAM's perspective before we move on. So Build America Mutual, we guarantee the debts for about 5,800 communities nationwide. A lot of them are smaller and medium-sized issuers across the country, in rural areas in particular. And in a lot of those places, when we do our credit analysis, one of the things we look at is just the depth of the economy, because if one or two employers is impacted, that can have a real significant implication for the ability to repay. And one of the things we found in this particular recession, which is kind of different than others tied to COVID, was that those smaller communities in a lot of places were the ones that saw the greatest tax revenue growth, because some people relocated out of the cities, but by and large the economic activity in those communities was stable or up versus the rest of the country. So it was a little bit of a different kind of a recession from what we've experienced historically, but very strong across the muni market. The other lesson I think a lot of people learned was just how robust the muni market is from a structural perspective. Most issuers have debt service reserve funds and cash on hand so that they can withstand temporary interruptions in economic activity and still have a long-term stability. So that was an important takeaway and something that we're watching as new transactions are structured going forward, making sure that structural robustness stays in the marketplace. Before we go, I'm going to go off script here for a second, David, because we did get a question from the audience in our question poll. It's about the new issue marketplace and issuers selling new issues. And the question is, there are retail order periods and opportunities for individual investors who are more focused on buy and hold to get involved. What are those working well? Are there things that can be done differently to increase that kind of participation? I assume as an issuer, you want those buyers in your investor base.
We do, and they've actually worked pretty effectively for us. And I think they've worked effectively for many issuers. What we have seen over several years now is a decided shift from direct retail to SMAs, and that actually followed, as I'm sure you're aware, Michael, as the bond insurers had difficulty, coming out of 2008, 2009. Individual investors were buying a lot of insured paper, and as they went away, the SMAs stepped into the breach and to help their clients navigate the municipal market, because there were several different types of issuers, different credits, and it's hard for an individual to understand all of the different credits we have. But retail has been an active participant for us and for many large issuers, and we've had great success with those with retail order periods. And because many institutions are different parts of the yield curve, it actually has worked out. But we try to do our allocations so that institutions have access to in a wide variety of maturities and structures. But we encourage retail investors. They're still a solid part of the investor base for municipal bonds, whether in the new issue market or in the secondary. So we want to encourage that.
Are you looking at technology at all to find easier on-ramps for them?
I think as we go forward, there may be. It's the municipal market is a very unique one, and we will adapt as the technology adapts. But it's important for us to get we need all pockets of demand. There are none that we can shut off effectively, especially given the amount of debt that we expect to issue, and we want investors to be comfortable in buying our bonds.
So again, great segue. One thing that I think people don't appreciate is that historically, about 70% of all of the public infrastructure investment in schools, water and sewer system, roads across the country is actually raised in the municipal bond market. We've for now decades have heard people in Washington talk about the federal role in infrastructure and trying to boost that. But over that time, the bread and butter was done in the municipal bond market. Now, the federal government has taken a fairly substantial act with the IIJA, and that money is starting to flow out. How do you think that will impact the municipal market? Is that going to be less net borrowing going forward because the federal government is making these grants, or how do you think that plays out?
I'll take it from an issuer perspective, and the way the Infrastructure Act is put together, those funds tend to are flowing through the states, and then the states have to allocate them to localities and to municipalities and counties. There's money available for water and sewer. There's significant money available for transportation, and many of them are competitive grants. And so the various agencies in the city that use those monies are actively preparing their applications. In New York City's case, if they're water related, those projects will be funded. We fund that through our separate water finance authority. And so to the extent that we can get federal money available and to offset some of the bonds that we might do, that would be helpful. But it remains to be seen how much of that flows directly down to when it gets to us, when it gets to the city level. But certainly we'll be taking advantage of every opportunity we can.
And I was just reading a program. It was one of the more obscure programs, but there's a railroad grade crossing elimination subsidy program inside the bill. And that requires local communities that are trying to finance those projects to put up 20% of the money on their own in order to gain the rest of the money from the federal grant. So, historically, I think there's been a lot of municipal bond activity where people sell bonds to raise money in the new issue market to do the matching funds that allow them to unlock other grants. So with more activity, that could also drive an uptick. Patrick, at Nuveen, do you have an opinion on the outlook for kind of new money supply? Is that something you're expecting?
We've seen, and I think that it kind of varies per participant in the market, we've seen estimates that continue to be high on the year, even though we've been moderately trailing last year's pace. I think obviously that will depend very much so on the course of rates in the near term, and really as we get into the fall, where we tend to see another uptick in issuance. Our kind of read on the credit research side has been that issuers have deferred somewhat as they, as was pointed out by David, that as they kind of find out what their inflow from federal stimulus will be going forward. But I think that, as you point out, there's a continued need for borrowing. We'll continue to see major issuers coming to the market in various size. The rate market is going to determine whether or not we see that come as continued tax exempt or more of a taxable flavor like we've seen over the past few years, which has simmered down somewhat in recent months. So I don't have an exact number for you, but I think that we're always in the ballpark when it comes to the actual long-term estimate for what the year's supply will be.
Thanks. So we're coming down. I want to take a look at the poll before we wrap up the session. I looked over there, and not everyone in the session has voted in the poll, but as the political analysts say, I think I've seen enough. We had three options. How have clients reacted to the volatility in the market? Buy, sell, or hold. 10% bought, 10% sold, and 80% said they held and stayed the course. Again, Patrick, that kind of reflects some of the feedback we got, and David, you got from the individual investors in the SMA business or the direct owners, that they were in this for the longer haul and were buy and sell investors. And as we talk, the held percentage is even increasing right now. Does anything about that surprise you, gentlemen, as we see the results?
Well, I think given the magnitude of flows that we've seen so far, we've certainly, or outflows from mutual funds and SMA complexes, we've certainly seen some selling, but I think when you consider the aggregate base and the overall size of the market, it really has been somewhat of a marginal or incremental selling pressure. I think that the held portion gives me the idea that, as you point out, a lot of individual investors are long-term oriented in their nature. And as the flows continue to move towards managed money as opposed to the traditional transactional brokerage style of account, that's where we're going to try to be active. But obviously the account still stays intact in terms of the overall size of the portfolio.
Great. So I'm sorry, David, go ahead.
No, I was going to say, I mean, for every seller, there is a buyer. And if the bond funds are selling, that probably means that SMAs and retail bank portfolios, more longer term, buy and hold type investors are buying. And that's the off ramp, if you will, to the bond funds. You also have the trading accounts and so on and so forth, providing liquidity in the market. So while the bond funds may be selling, and that puts upward pressure on rates and upward pressure on spread, on trading spreads, but there are still buyers out there that are, that we're thankful there are still buyers out there that believe in this market, believe in the strong credit story, and we continue to think it has been a traditionally very safe market.
So Patrick, bringing it into the home stretch, if you want to leave the audience with a few takeaways as far as how they approach the municipal bond market, what advice would you offer advisors right now? And I'm going to ask you to work in one of the questions from the chat pane, which is, what do you see as the largest risks from muni bonds in the market today?
Sure. Well, I mean, I'll take that up front. I think obviously what we've seen so far this year, the rate volatility poses the most near-term risk, but it also presents, I think, the longest-term opportunity as well. As we look at the market, and so many other market participants have noted, your long run returns, your 3, 5, 7 year and longer type of returns are most closely associated with the yield that you're buying bonds at. So given that we're, like I said earlier, nearly 200 basis points higher in yield than we were just to start the year, I think for a lot of long-term investors that have been looking at a better opportunity to allocate cash than we had seen really over the past year or so when rates had dipped in that 1% environment, this might pose an opportunity. My other point, and I think that this is an ongoing conversation that we've been having as we talk to clients over the years, is that investors, especially those with the means to have a larger presence in the market, continue to benefit from a diversified approach, a core portion of your portfolio that can be of individual bonds that can be augmented or complemented by various different approaches, wrappers, mutual funds, closed-end funds, ETFs that can more narrowly define or more closely refine your overall duration and credit exposure within your portfolio and your overall municipal allocation.
That is one of our go-to phrases around here. When you've seen one muni bond, you've seen one muni bond. That the revenue streams across this market can be very diverse. There are a lot of bonds, general obligation bonds anchored in the local community, the local property tax base, but then there are also a lot of exceptions to those rules and it can be idiosyncratic risks that require some transaction level research. David, any last points before we wrap up?
I would only say that the municipal market in general, again, has been a very strong credit market, strong market for fixed income investors. As rates have moved higher, it should be even more attractive to investors as a longer term investment hold. We're encouraged by the variety of participants that are buying in this market, and as rates move higher, perhaps Patrick, volume may be more muted as refinancing, refunding transactions become more challenging. But municipalities still do need to borrow, and we will be around for a long time. We are solid credits, and we rely on investor participation. We encourage their participation. We encourage questions, and that I will leave you there.
Well, thank you both so much for joining us today. We really appreciate the time and your insights.